If you think about it, we are talking about 70, 80 years of data, right? US is compounded at 10% plus, double digit, okay? The second largest economy or the cluster, which is compounded at reasonably high rates of return, is the Nordic region, okay? The reason why stocks compound at those rates is not the growth rate of the economy, it is the inherent capital efficiencies of the companies.
Wow.
Okay, so it's the ROEs that matter, or the spread between ROE and cost of capital that matters, right? So as long as you've got companies which can compound their and reinvest their cash flows back into the companies and kind of grow that, okay, that is what matters.
Folks, welcome to PaisaVaisa. I'm your Anupam Gupta, B50 on Twitter. And on today's episode, I'm thrilled to welcome back Harish Krishnan, Co-CIO and Head Equity at Aditya Birla Sun Life Mutual Fund. We are talking about equity market, mutual funds, trends, patterns, data, quant, fundamentals, and much more. So we last had Harish Krishnan a year and a half ago in Jan 2023 when he was with Kotak Mutual Fund. And since then, of course, he's gone on to Aditya Birla Sun Life Mutual Fund as the Co-CIO and Head of Equities. Harish, welcome back to PaisaVaisa. Thank you so much for doing this for your listeners.
Delighted to be back, as always, Anupam.
And in a new role this time. Lovely.
Yes.
So, and folks, just a small programming note again, right? Because this is what I said the last time that Harish was here. Please follow him on Twitter, HKTG13. His tweets are always interesting and they'll make you think about something or the other. Okay, like I'm going to discuss a few of his tweets now also. But before I get to that, Harish, what's your view on flows, right? We were here in Jan 2023. SIP was at its own number. FI was at its own number. And here we are in end of July 2024. Like almost 1.5 years is gone. Lot has changed. Forget sentiment and all that. But purely on flows, what's your take?
So, Anupam, markets reward rate of change, right? And if you look at, say, there are broadly three investment participants. You've got the DII. Mutual funds are today the key vehicle in which DII flows are coming through. You've got FIIs, the traditional people who had invested a lot in the 90s, in the late 90s and the 2000s. And then you had the HNI and the retail, right? What we've seen is that, while a lot of focus is on SIP flows, etc., the reality, in my opinion, mutual funds and the domestic investment houses have become like the foundation of the markets. So, in the sense that people are able to gauge that every month, maybe say X number of rupees, is going to come from mutual funds, and the market has its own memory, right? And so therefore it'll kind of piece in that, okay, this much demand is going to come from these set of players, right? So what matters to the markets is who is the player at the margin and what is the liquidity that they can provide, and therefore they set the pricing, right? So the two big differences are what has happened to the HNI retail flows as well as to the FI flows. So let's take the FI flows first. FI flows from 95 till now, they've put in close to about 200 to 25 billion dollars over the course of time, and that is being valued at about 700 billion dollars. So it's an IRR of about 8 odd percent in dollar terms. All good. What we saw from 2016 onwards is that the foreign flows have moved more and more into FDI compared to FII. So it's not been a new trend, but over the course of the last, I would say, 7 8 years,
Yep.
we've seen the shift that more allocations are happening onto the FDI side. Of course, from the FDI side, now they're coming in for exits as many private equity come to list, and there are all these blocks, etc., happening. But the real big surprise has happened onto the retail and HNI side. So, if you look at the numbers from 2010 to 2019, okay, there was actually net outflow of direct equity cumulatively,
Yep.
and it seemed that all the money was going into pooled vehicles like mutual funds and ULIPs and all of that on the insurance side, right? Starting from 2020, we've seen a big shift.
Okay.
And which is where now we are talking about some very big numbers, and they being the elephant in the room in terms of driving. So I have a conspiracy theory in the sense
Okay.
that there is no way in which we can. It's a hypothesis. I
Yeah,
wouldn't say a
yeah.
conspiracy. It's a hypothesis. That's the right word. See, broadly, if you were to look at what has happened since pre-COVID till now, okay, the fiscal deficit of the government has gone up because during the COVID pandemic, they of course spent a lot more than what they earned, etc. Right? But the fiscal deficit can be broken down into two parts. So you have the primary deficit and the rest. The
Hmm.
primary deficit is basically the fiscal deficit less the interest cost.
Correct.
Okay.
Yeah.
The base principle being that the interest cost is not only for that particular year, it is for servicing the debt that you have
Yeah.
incurred over the course of the last 10, 20, 30 years,
Sure.
right?
Sure.
Now, if you look at primary deficit, they are already close to what it was pre-pandemic level.
Hmm.
Okay.
Hmm.
So the big delta increase is the interest cost. So the interest cost, now that is, as far as the government is concerned, it's a cost, right?
Yeah.
Now, somebody else's cost is somebody else's revenue. So you're talking about a series of interest payments as a percentage of GDP, which has gone up.
Hmm.
As a percentage of GDP, we have gone up by about 0.5%,
Okay.
right? Now, typically in any society, you've got the haves and the have-nots,
Yeah.
right?
Yeah.
The haves are the top 5, 10, 15% of households, and the have-nots the rest, right? The haves have capital, the have-nots are primarily labor and consumers,
Mhm.
right? Now, so in effect, this increase in interest cost of the government has gone for the top 5, 10% of households which have capital. Okay.
Hmm.
And so suddenly you are seeing a greater amount of capital which is available, which is sloshing in various asset classes. So
Wow.
you've got basically say FNO, you've got cash equities, you've got real estate, you've got Dream 11, you've got crypto, you've got all of these various avenues. It could be even travel. You're seeing the entire K-shaped recovery also, wherein you're seeing more premiumizing, more luxury travel, etc. So I think it's a combination of all of these that has also trickled into markets in a meaningful way. And so therefore, I would say when we talk about flows, I think that the real key element that needs to be tracked now is how's the retail sentiment and how's the retail flows. And for now, it looks like there is no tomorrow. There's no stopping it.
Yeah. So, folks, just a small note again here that if you go back to Harish's episode that we had done back in Jan 2023, we spoke a lot about the behavioral aspect, about how, what was the data that you'd given us, that lotteries in Kerala were like almost 12,000 crore at that point
Yeah,
of
at that
time?
point of time, lotteries were about 12,000 crores,
Yeah.
and they the deposits at that time were about 17,000 crores.
Yeah.
So just lotteries were almost about 70% of the deposits that were coming. And these are data points that shock, right?
Yeah.
I'll give you another data point that we released out. We keep talking about equities, right? And I spoke about both of these avenues. You have funds as well as direct equities.
Hmm.
Okay. Now, while it's always known that Indians are traditionally more physical assets, you've got gold, real
Real
estate,
estate.
and
Yeah.
then FDs, and then you've got these avenues, right? But it might surprise you and your listeners that the total cash which is earning zero, okay, which is not in the banking system,
Hmm.
which is outside of the banking system, right? That is almost equal to 75% of the total value of all the household's wealth in equity. It includes direct equities as well as mutual funds. So an
Wow.
asset class which is earning 0% is
Ah.
75%. It's almost close to about 40 lakh crores.
Ah.
The total value of equity mutual funds is about 25, 26 lakh crores of households.
Hmm.
Direct equities is under 25, 26 lakh crores. So we're talking about just cash which is giving you 0% at 75. So these choices of aggregate
Will
household,
always. Yeah.
I mean, these quirks will always exist, and the idea is to channelize them in a way that is more productive for the economy as well as for the households.
So we spoke about the quantity of flows and the quantity of money and the value of it. What about the quality? The fact that in equities, this is, are you okay with where it's going, right? Because I think in the last few years, again, I don't know whether it's a permanent change or it is just retail investors doing what they know, which is chasing returns,
Mhm.
landing up in NFOs, landing up in sectoral funds, landing up in small and mid caps, which have been on a tear for the last, I think this is the fifth year of that mid cap and small cap versus large cap. So quality wise, how do you think the flows are going?
See, these are all choices that we'll get to know 5, 10 years down the line, right? I think the broader aspect is, we need to be wary of when these choices and the herding of flows go to an extent where it is completely different from, say, the fundamentals and reality on the ground. Okay. So if you take at markets as in totality, okay, earnings, because that is the typically they say that markets are a slave of earnings, right?
Earnings.
Earnings have gone up close to about 2.5 times from pre-COVID till now.
Hmm.
Okay, markets of course have gone up more than that. It's gone up about 3 times from there. So there is a slight delta which has definitely gone up, right? But if I were to break down the market cap delta into earnings delta and valuation delta, so from pre-COVID till now, right? For large cap, the top 100 companies,
Yep.
right? Broadly, the earnings delta more than explains the market cap delta. In a sense, the valuations have derated. So banks have derated, metals have derated, etc. Right? Talk about mid caps. The same number is roughly 67% of the market cap growth is coming from earnings. 33% is from valuation delta difference.
Okay.
You come to small cap, it is 50-50. Okay, you come to micro caps, it is 1/3 of earnings and
Wow.
2/3 of
So from
valuation.
100, we've come down to
Yeah, to 1/3. So I think clearly there has been a exuberance of sorts to say that it's going, and then of course micro caps is still okay. You move to the SME side
I
where it's
remember that tweet
clearly
of
the
yours.
wild
Yeah, yeah.
wild west,
What is
right?
that number? You put some insane number. You said that the BSE SME IPO index. I didn't know there's such a thing, by the way. Okay, and there's an index.
Even I didn't know till that I
I
saw
wish
that.
somebody put an ETF for that, and I could have invested in that tracker. But sorry, what was that number?
No, so see, the Sensex has taken whatever 40-50 years to get to whatever 80,000 levels, right? That's where we are. The BSE SME IPO index, which kicked off in 2016, it was going nowhere till 2020-21, right? From 21 till now, I think, I don't know what the latest reading is, but the latest reading I think is about 90,000. So what took the Sensex about 40-50 years to get through? You've got the SME IPO index of BSE, which has traversed that entire distance in about 3 years and more. So that's the extent of the parabolic move that has happened.
You're talking about an index here.
Yeah.
No, you're talking about individuals. An index is supposed to be representative of. Oh my God. I could take this entire episode on this discussion, but let's move on. Okay, let's kind of leave
Park
that
it,
there.
yeah.
I mutual fund industry. Okay, you like we were talking before this episode started about how the equities part. Of course, at a total level, we are at 60 lakh crores. If I have the number right, we were celebrating 50 lakh crore only a few months ago. Now we are at 60 lakh crore. What's your view on the industry? Like, where are we today with this money versus the journey that this industry has had from 1 to 25, whatever. Let's kind of talk about that so that going from here going forward, how will it have to change?
Right. So I think the industry still is at its infancy when we think of the bigger journey ahead, because in most countries, as we are aware, the banking system is a fraction of the fund industry. Okay, whereas out here we are still only about 25% of the banking industry. So there still is a meaningful delta that needs to be traversed. I think the industry from the inside, and this I'm saying from an investment point of view, when I joined the industry, it used to be about 1 lakh crores of total equity AUM,
Equities,
right?
correct. Yeah,
And today it's at whatever 25-30 lakh crores of equity AUM, right? Now, over the course of this time frame, we've seen some interesting innovation. We've seen some model-based, rule-based investment. We've seen categories like, say, balance advantage funds, etc., which have tried to optimize on the experience element for investors than necessarily only choosing the dimension of returns alone, right? And that's a very interesting and encouraging development, which is led. Of course, you've got mutual fund Sahi Hai campaign, which kind of galvanized this entire, channelize these savings into various asset classes and funds, etc. Right? But when I look at internally, what we've seen is the way we used to manage, say, 1 lakh crores and the way we used to manage, and I'm saying as an industry, I would say that, not a lot has changed. And to be fair, investment is not something that you need to change. I mean, it's not that, the Ben Graham and the way Charlie Munger and, say, Warren Buffett, etc., describe it needs to dramatically change, right? Investment is at the core, it's a timeless classic, right? But at the margin, if I were to think of the big development that changed through was the implementation of risk management, right? There was a phase till, say, 2007 GFC, where it was still the wild wild west, in the sense that you like something, you go buy it, you don't worry about risk, right? And I think over the course of the last decade, we have come to a level where risk has been the only key dimension which has changed, which is that, you want to handle it with a certain amount of benchmarking, top down, whatever, what have you, right? But I think at the margin, we need to move on beyond this, right? Which is where the use of technology comes in. The use of testing of strategies come through. And in some sense, think of it in three dimensions, right?
Mm.
You've got, say, one dimension of active insight.
Yeah.
Okay,
Yeah. Yeah.
which is where fund managers want to be known for saying that this is my variant perception on a particular stock, and therefore you make that money, right?
Yeah.
The second dimension is that of, let me say, cost. Okay, and this is where the entire dimension of active passive typically comes through. Though in India, possibly we are not yet at that stage where there's too much of a
Mm.
difference,
Mm.
right? But that's the other element. With scale, you obviously want a lower cost, which is a fair thing. But I think the dimension that gets ignored is the repeatability dimension, which is that, if you think that, value is going to perform, will your value fund do as well as a value factor? What is the element of repeatability that comes through is where I think we need to build greater over the course of the next, as we traverse from, say, 25 lakh crores to 50 or 75.
Mm.
And for that, I think there's a whole amount of technology that needs to come useful for.
Wow.
Okay. So to detect frauds, to detect or to identify places where to sell. There are some wonderful books which keep saying that the difference between a good fund manager and a great fund manager is not so much what they buy,
Yeah.
but what they sell. Okay, so what is your selling process? And selling is a very difficult emotional process, right? Because selling always comes with regret. Either you regret selling too early or too late. How do you therefore try and get it into a slightly more rule driven approach for selling is something that, and that is where I think that repeatability dimension starts getting, more and more solidified, so that we can try and build this entire ecosystem wherein you have a greater confidence as fiduciaries that we are doing it right for our unit holders, with a reasonable amount of freedom of active insights, some amount of cost synergy is
Mm.
definitely coming through, but a greater focus on repeatability. At least that's the way I see it over the course of the next 5, 10, 15, 20 years,
Yeah.
in an industry which is still at its infancy.
You've given me a great hook to go into the second half of the show. How can we as investors do this? You made such a wonderful point on selling.
Hmm.
I know that it's a pain. It's a pain
Yes.
everywhere. You would
Yes.
know this more than me. You spoke about selling. Now we are in here in 2024. You've been in this industry for a long time. We can talk about quant and fundamental. There was a time where neither, we were more in the fundamental school of thought, price to earning, cycles, this, that. And now we've come where people can actually have a long discussion just on quants, saying that bhav bhagwan hai, I don't care about balance sheets, I don't care about
Yeah.
earnings. Is there something in the middle, and how can our audience out there, use this when they're making their own portfolio?
Sure. So I think that, to our mind, man plus machine is better than man or machine. That's the starting point. Okay. There are certain insights and utility of human beings, and there are certain utilities. How you want to blend them is what creates magic, right? So if you were to think about, from a strength of the human mind, okay, and let's talk about mutual funds. Generally, we've got now a reasonable 25, 30-year track record of so many cycles, wherein, see, generally, if you think about mutual fund managers and their portfolios, the thing that stands out to me is that you generally don't see mutual fund managers wanting to partner with bad companies.
Mm.
The ability to do due diligence, the softer aspects of whom to bet on, and more importantly, whom not to bet on, is very, very high. It could be because of our reputation, our fear, or whatever be it, herding mentality, come what may. The reality is that I think human beings are far, far better at that. Now, while you have strategies which can help detect fraud from a quant based perspective, this softer aspect of meeting a promoter, trying to gauge what really is interest are, how this alignment, and I think it comes in very, very strongly from a human
Yep.
application.
Yep.
It cannot be so much brought into it. Where we struggle as human beings, as we just discussed, is selling, right? The emotional aspect, right? In many cases, be it in retail investors or professional fund managers, we are like Abhimanyus.
Mm.
We know how to get in, but getting out is always a pain, right? On the other hand, if you think of quant or rule based, let's say rule based is a better word
Yeah.
than
Yeah.
only quant, right? You've got basically a poor way in which you can do diligence also, okay, but you've got a very unemotional way to do when it comes to execution, okay,
Okay.
and that is where you try and blend in both of these to try and do it. So let me give you now. Obviously, the rules can keep be different for different kind of people. You can be a value focused guy, in which case you need to have the discipline to get out without the FOMO saying that okay, what if I sell out and it goes up. Now,
Mm.
for that to happen, you need to have a rigorous testing of your strategy, saying that, okay, on a probability, on evidence, are you getting more calls right than wrong, right? And it can't be influenced by one call going right or one call
Correct.
going
Yeah.
wrong, right? Similarly, if you're a momentum or if you're focused on price as your key determinant, you can continue to keep riding that particular name till the momentum kind of
Changes. Yeah.
drops out, right?
Drops off. Yeah.
Now, these can work for niches. Okay, at a small AUM, you can do all of these things. But on a larger AUM, you need something beyond this, right?
Mm. Mm.
And which is where you use the insight, which is the signal is dropping off.
Yeah.
Okay.
Yeah. Yeah.
Now you cannot turn. So at say at Birla, where we are managing 1.75 lakh crores, we cannot move out of a stock and get into a stock at a dime, right?
Yeah.
But you can use that same insight, which is if the signal drops off, you need to have a following checklist saying
Okay.
that what is it that you're going to do. Okay, are you going to meet the management? Now, once you meet the management, these are the 5 things that you want to focus on. Once you get to that break point, what is the 3 decisions that you can do it? See, the it's like I think Kahneman has it right, wherein you've got the fast brain and the slow
Slow
brain,
brain.
whatever,
Yeah.
right? Now, in terms of decision making, the buying decision can be done by the slower aspect,
Mm.
okay, because there's a lot of nuance, there's a lot of thinking. The selling decision, let it be done by the faster aspect,
Wow.
okay. So therefore you make it a rule based thing. So once you kind of do this, your overall outcomes and the repeatability of that outcome, to my mind at least, we've seen that change up quite dramatically. So you do all your typical fundamental based, and I'm not saying fundamental
Mm.
is
Mm.
right or
Mm.
wrong, or whatever be it that you're comfortable with, okay, but deliberate a lot, do as much diligence till you get comfortable to pull the trigger, okay. But when it comes to selling, stick to the process. Don't allow discretion to come in. The moment you allow discretion to come into selling, it becomes a problem. You can allow discretion in buying, but not in selling. So
Very
yeah.
interesting. Well, you have the same conversation at a party where you're slightly more informal and you can chill out, and you have like 5 people coming to you saying, Harish, I have tripled my portfolio.
Mm.
Like, what to do? Should I sell? Like, I'm sure that you will tell them the same thing that you said, and you'll probably point them to this episode to watch. But for a retailer, how should he approach it? Because we are at a point where we are where the nifty is. Some people have been left behind. Some people who had the right training of staying in it for the long term are probably enjoying the benefits of that. No one's to say that benefit will last forever.
Ever.
We don't know whether that trend will continue or not. But for a retail investor who has a portfolio, and I'm talking purely mutual funds, okay, I don't want to get into
Stocks.
equities because that's a totally different discussion, which is more stock specific. But for someone with a mutual fund portfolio who's been investing for whatever time that he has, what would you tell him? Like if you come to a point of selling, what should he keep in mind?
I think, see, investment, exercise, all of them are similar. Sports, right? At the end of the day, we can get carried away by the fad of the moment. You
Mm.
can have multiple funds in your portfolio, and you can try and eke out the maximum return from every theme. But the reality is that it's like a thali. Your bread and butter or your key ingredients need to be your core.
Mm.
So as long as you want to reallocate back to the core, uh, times like these are very good times to get back to core, okay.
Very interesting.
These are
Yeah.
not times to experiment. See, this is a time where risk has got disproportionately rewarded. I mean, you don't need me. I mean, you can look at everywhere around you to get that sense, right? And therefore it and doesn't mean that you have to stay in a bunker and shun
Mm.
all equity. But it's a time to be slightly more contra, which is,
Mm.
if everybody is chasing that, let me try and do something else,
Yeah.
which is try and reverse my portfolio decision making, saying that let me do fewer decisions, let me consolidate my holdings. Now, within consolidation, again, the typical approach is, you sell out of the weaker performing names. Now, I think some more nuance is needed there.
Sure.
Okay, performance is cyclical. Okay, and therefore you want to try and get into some aspects which are performing, some of which haven't performed, but you consolidate within them. There are nowadays a lot of tools which can do factor analysis of various funds, so that you get to see that are your funds all similar. Okay, in which case it makes sense that whatever is similar you consolidate into one, and try and have varied kind of factor exposures out there. That could be one approach. At the end of the day, I think at this point of time what we are suggestive is that you need risk has got disproportionately rewarded. You need to dial down some element of risk. So I mean, the example that we keep giving is, if you were otherwise in small cap predominantly, now is the time to be in mid caps. If you are in mid caps, be it in large and mid caps. If you're in large and mid caps predominantly, be it in flexi cap, etc. So you know what your risk is best. Try and tone down by a bit. You don't have to go completely the other dimension, saying that I'll shun equities, etc. But at least tone down the risk.
And the industry has those kind of products.
Yes.
Talking of which, are you a believer in the hybrids, balance advantage, dynamic asset allocation? Because I am not in the equity markets anymore, thankfully. That used to be my full-time career at some point of time. But having done that, I'm just very comfortable in the mutual funds that I have. Over the last, I think the only change that I made after the pandemic was that I just thought, let me have a look at these BAFs and DAFs. You call them balance advantage, dynamic asset allocation, whatever. I kind of thought they suited my risk return profile. They suited my financial objectives. In general, how do you think these vehicles are for someone who's sitting on a portfolio right now where he's actually wants to know how to protect those profits and not get into a place where if the market turns, which it definitely can, what do I do? So what's your view on these products from a retail perspective?
No, so I think these products are the core of any investor, if you ask me. Now, see, this is a journey that we are all traversing through, right? Now, and I'm going to give a slightly more nuanced take on this, right? See, if I think of my dad's generation, okay, he had invested in mutual funds like an optionality. Okay, nobody really knew about mutual funds. He also bought NFOs at 10 rupees, all of those that came, and we are talking about the 90s, right? He had also invested in teak. He had also invested in emu farms. I'm just saying that these are the choices that
Were available to them.
that are available to them, that they invest in,
and
right?
they assess their risk return at that point of time. And then,
correct.
Wonderful
Right?
point. Go on,
Right.
please.
So, with the benefit of hindsight, now we know that all those were foolish decisions, to put it bluntly. But you are taking decisions which were available to you at that point of time. Now, over a course of say 10 years, 15 years, is when he has come to realize that all of these is bakwas, and which is that on April 1st, he puts in that 1.5 lakh rupees religiously into his tax saving fund. And now he is looking after every fall to invest more and more into it.
Nice.
Now, the point is, it's taken him 30 years to get at first which are the ones that he should not be at. And then to get comfort that he can go into the deeper end of the pool. And he, even in the 70s, he is very happy with being small cap and mid cap, etc. So that's perfectly fine. Now, that is the generation, or that is the habit that sometimes takes 20-30 years to get there, right? Now, how do we short circuit this entire thing, right? That is the role of the hybrid instrument. Because what has happened is that most investors have either been in the camp of purely fixed deposits, okay, or they went into the other camp of, say, being in gold and property. And then you have this emu or whatever. I'm not saying that crypto, etc., but these are the choices that are available today: a dream 11 or a crypto, etc., whatever have you, right? Now, you can choose to be in all of that, right? Now, the point is, if you want to move the bulk of your core from an FD, because that is the traditional Indian mindset, to move into, say, market-linked returns, these products try and provide you that, because their focus is primarily on the experience of the investor. It is not on the returns, okay? Because at the end of the day, a asset allocation product will have a 50-60% weightage to equity. Now, there is no way that a 50-60% asset class can beat a 100% asset class in full form, right? That is
Works both sides.
It works both ways, right? So when markets are in a tear, you will feel like a loser saying that why you are only 50-60%. Similarly, when markets go down, you will say, why are you at 50-60%? But the reality is, over these cycles and the fact that they can move up and down has provided them a greater comfort in handling out. So therefore, when you look at data, Okay, if you look at the typical, and this is say about a year back data, I don't have the latest
Sure, sure,
data,
sure.
but if you look at the average folio size,
Hmm.
okay, of any other fund category, it could be large cap, flexi cap,
Hmm.
tax, what have you,
Yeah.
okay, they typically a small cap, mid cap, they're all oscillating between say 1.2 lakh to 1.5, 1.7 lakh.
Okay.
This is the average folio size in a fund,
Sure,
okay.
sure.
But if you look at this category of BAF and DAF or even hybrids to a certain, that number goes to 5 lakh.
Is
Okay,
that right?
right. So
Oh,
that is
that's
such
a
a
what a
so,
statistic!
so
Wow.
the idea is that these are our core. This is what you want to get from the FD to experience markets to
Wow.
short circuit that entire experience. My dad took 30 years to get there.
Huh.
Okay. Through this experience, you are trying to do it in 5, 7 years.
Yeah.
So that once they experience the up and down of markets and then they realize it, they can try and move into that. So that is one utility.
Yeah.
The second utility is what you said. Because as you go higher and higher and say more and more of your wealth is getting into equity markets
Mm.
and you're close to your goal, maybe retirement for
Mm.
example, okay, then you're constantly worried that will my wealth also kind of switch, and which is possibly where you are coming from, right?
Yeah.
And for that purpose also a dynamic asset allocation or a balanced BAF or whatever you have or an asset allocation product fits in very well. So I think both for the first timers as well as for those who have made it, okay, and who want to therefore safeguard their wealth, and they are all valid choices,
Yeah,
right?
yeah, yeah,
And
yeah.
there is somebody who wants to accelerate their wealth, there are some who want to protect it. I think
Yeah.
for both of these ends is where I think hybrids as a category make a lot of sense.
Yeah. And I mean, there is a whole range to choose from, thankfully. And as of now, the taxation is still stable there. So let's not talking about that. Okay, winding down the episode, Harish, your take on markets. Where do you think we are? You already gave us a lot of numbers to think about when you spoke about how earnings and market cap for the entire spectrum, large to micro, has moved. And like you said, we are in a place, sorry, where within large caps, we are at 100 and 100 or whatever, zero, that
Valuation expansion
valuation, then earnings are all on
matching.
on track. Whereas in the lower end, there's probably some froth, whatever it is. But leaving aside that, we look at the overall picture right now, Nifty where it is, earnings where they are, interest rates where they are. What's your take going forward on equities in India?
So I think there's still money to be made in equities. We continue to remain positive on equities. See, it's the issue is with the expectations of what to make from equities, right? And that's where the issue is. So see, the last 3, 4 years we've seen earnings double. Okay, we think that the next wave of doubling of earnings would be between 6 to 7 years. Okay, and and therefore that is where you should be thinking about when it comes to say wealth creation from equities as well. Now this is our best case understanding, right? Why do we think earnings can potentially double in the next 6, 7 years? I think for that we need to have confidence in capex, because capex done today is the source of future cash flows and future profits, right? So if you look at say cash flows have moved up from 6 lakh crores for the listed entities pre-COVID to about 9 lakh crores. The same time frame, earnings have moved from 6 lakh crores to 14 lakh crores. So that's a problem of plenty today, which is that there is more cash flow that is getting released than what is getting invested in. We think, and that's a range of reasons. I think people are still scarred of the 2015 to 2019,
The
where
markets
they
went nowhere.
markets went, and more importantly, companies were worried that they'll become an NPA.
Yeah,
So
yeah,
we are
yeah.
talking about companies, right?
Yeah, the
On the
twin balance sheet
corporate
problem. Yeah,
problem was
yeah.
coming through. So it takes some time, but we do think that this 9 lakh crores can potentially become 12, 14, 15 lakh crores in this cycle, right? And that is what is likely to create that next wave of doubling over the course of the next, whatever, 6, 7 years, right? And so therefore, as long as you're anchored to that, we think that, it still does make sense to be in equities. We of course, in the near term, the last 3 months specifically has been a uplift, which is kind of surprised, to be quite honest, because you've had events which weren't that supportive of taking risk, and markets have gone
Still,
through it
yeah, yeah.
without any effort, so to speak.
Talk about wall of worry, huh?
A massive climb up, right? And so therefore, can there be some froth which kind of gets adjusted? Can there be a time correction? All of that is possible, but yeah, as long as your bigger picture, which is let me kind of end with this kind of stat, right? um, see, ultimately, we all know that India's share of the world GDP will go up.
Mm.
Okay.
Mm.
We are talking about being the third largest and all that, right? So today we are at 3.7% of the world GDP.
Yeah.
Okay. Market cap at the end of last year was at 3.9% of the world GDP. Today, of course, it's at 4.2. Okay.
Okay.
So there is a slightly more
Yeah.
delta. Now, as long as you are convinced, which I am, that this 3.7 is likely to be anywhere between 7 to 10% over the course of the next 10-15 years.
Mm.
Okay.
Mm.
We think that the world market cap or the market cap share of India also should go up to a reasonable extent, right?
Yeah.
And therefore we think that stay invested for the next 10-15 years.
Yeah.
Just pace yourself in terms of expectations more than anything else.
Yeah.
That's a tough part, but yeah, it's as simple as that.
So I got that expectation part at the starting of your answer also. Investor expectation. Okay.
Mhm.
Now RBI has this inflation expectation thing which they do in their policy.
Sure.
A very nice way of figuring out where people are thinking. What is the investor expectation today of equity returns going forward? What do you think? Where are we at?
No, we
And
we
is there even a scientific way or numerical or data ML AI driven way of figuring that out?
No, so there is a way in which is known as the equity risk
Premium,
premium
yeah.
and all that,
Yeah.
but those are all you can say too theoretical, too bookwormish,
Yeah.
etc. to make it. But eventually they do come and haunt at times to time,
Yeah.
right? But I think the last 3-4 years have kind of lulled people into thinking that making money is child's play. Okay, today everybody is a fund manager except the fund manager.
Mm.
Everybody has a view as to what we should do
Mm.
rather than ourselves, right? So I think therefore these are not the best of times to take that gauge on.
Mm.
I mean, we open our Twitter feeds and there are like we're inundated by comments that which are the stocks which can double in the next week, and I mean the time zones are shrinking so fast,
Yeah.
right? So I don't think that we need a reality check on that more than ever, but markets will do the thing that they do.
What about trailing 1 year returns versus inflation numbers?
So
I think trailing 1 year is like some seriously high number right now.
yes
20 plus, I guess, and it has stayed there for at least the last 3 or 4 months, I would say.
Yes.
And inflation is trending at what, 4%?
Yeah, so it depends on whether I think at the CPI level or the WPI, but I think it's more important to see what the retail investor feels what
That's
their
what, yeah.
inflation is, right? But see, in ultimately, I would say the bigger thing is the delta between earnings growth, because earnings in some sense is meant to protect inflation, right?
Correct.
I mean, over a long period
Yeah,
of time,
yeah.
right? And therefore that gap between what earnings has been and what valuations have gone up is where I think there's a big delta, okay, which either earnings can come through, which we are confident that earnings will come through over the course of the next 5-7 years. And therefore, a certain amount of time correction will help us all. But markets never listen to what we want to say. Markets tell what they have to say.
I go back to what the RBI says, right? That the inflation expectations should not get embedded.
That's
right
true. That's true.
Right now, somewhere I'm thinking,
That's true.
all of these people, they now you've got fancy retirement calculators and all that. मेरे ज़माने में तो वो भी नहीं था. Forget it. Just put in. You have Microsoft Excel. Just put in whatever you want out there and figure your life out. यार. Now you've got fancy retirement calculator, and I think somewhere people are just putting that 12 to 15% number in their head like this can last forever. For their sake, I hope it does, but
I don't think it's anywhere close to 12 to 15. I think those numbers have gone up.
What? Come on,
I mean,
thought
this is my personal read.
Oh shit! Seriously?
When I see people generally saying, because they're dismissive of 12-15% returns, or they're dismissive of 20%, they're dismissive of 25% returns in the statement. I am not talking of 1 year. I'm talking about 4 years, 5 years, 7 years. Right?
That's okay, yeah.
But people are like, bas itna hi. Obviously, it's not everyone, but I think it is no longer 12 to 15, which is I would say, I mean,
that's nominal GDP growth. You can make a case saying that 7 plus 5, so whatever, 12. There's a very big difference, by the way, between 12 and 15. I mean, saying 12 to 15 is one thing, but for a 30-year portfolio, that... Sorry, go on. Sorry.
I mean, firstly, I think this nominal GDP to market linkage is very, very stretched. Okay, it's a nice way of saying
That's
real
interesting.
plus inflation is equal to.
You don't, yeah?
No, I mean I mean there is. If you think about it, we are talking about 70, 80 years of data, right? US is compounded at 10% plus, double digit. Okay. The second largest economy, or the cluster, which is compounded at reasonably high rates of return, is the Nordic region. Okay. The reason why stocks compound at those rates is not the growth rate of the economy, it is the inherent capital efficiencies of the companies.
Wow.
Okay, so it's the ROEs that matter, or the spread between ROE and cost of capital that matters, right? So as long as you've got companies which can compound their and reinvest their cash flows back into the companies and kind of grow that, okay, that is what matters. Yes, in the bigger scheme of things, so therefore what matters is what the ROE of India is going to be at and where it is. So therefore, which is what the number that I showed, right? I mean, recently I posted it, that the number of companies, even after this, last 4 years, wherein earnings have doubled and more, even today, 50% of listed India does not even make 10% ROE.
Wait, I read that tweet of yours. I was
Yeah.
like, "Are you serious?" And that
So
that number was better in 2003, 2008.
yeah, I mean, we are getting there when we are talking about at least 10% ROE.
Huh.
But if I increase the threshold to say 15% ROE and 10% growth, or 20% ROE and 15% growth of earnings growth, okay, those numbers are like a third compared to, so one third of companies in the top 500 actually make that
Wow.
cut compared to 50% in the 2003 to 7. So the reality is that there are very few good companies that are there in any economy. It's not only a thing with India.
Yeah.
Okay, but when you see unabashed growth in the breadth, wherein any and every company is getting rewarded, then you know that it's not really going to lead to a great experience if you keep blindly following that. Okay, but I don't want to sound like a professor and a doomsday
No,
thing.
no, come on.
We continue to believe that equities is good.
Yeah.
Okay, it's just that one needs to moderate down, tone down expectations, be in the right companies, be in companies which have seen cycles, be in companies which are prudent. It is not the time to be experimentative. Be with tried and tested companies, I think, and let the companies do the hard work.
Huh.
We piggy bank on their hard work, and
Yeah,
then with our discipline, make the most of it.
But you've debunked my basic core central premise, and now I can sound very smart in a party also when I'm going, and I can show off, saying that
I
why
wonder
aisa.
which parties you're going to, which discuss all these.
No, come on. That's a nice. I like the implications of that, but yeah, I mean, it's something that I want to probably spend another entire episode on. But yeah, we will wrap this here and come back to us. Let's, after a year or 6 months or whatever, I want to revisit this number of implied expectations of equity returns, right? We started, I said 12 to 15%, and you said that that's really much lower than what people are actually talking about. Let's test that out.
Sure. Would love to
Let's,
know if there is a scientific or
yeah,
a poll in
yeah.
which we can actually see what is it that people are expecting.
And I want to revisit this. I want to like keep this as that kind of spoiler, that after the credits of a movie are over, you have that small scene. I want that to be like this right now, so that when we come back and revisit this, I want to look back at this episode saying that, listen, this is how. See, because
Stand out.
history is history, and markets have always corrected at excesses. I don't think that you
That's
would.
going to change. That's
I
not never going to
don't think
change.
that's going to change. So if people think that this is going to be 20-25% forever, then all the best to them is all that I can say. But yeah, our last question, and for you, of course, I love this question because you always have fascinating recommendations for what you're reading. So, what book are you reading, and what can you share with us for our audience?
So recently, I read this book called The Art of Execution. Okay, it's a very pithy, small book. Okay, it's actually for our industry, basically of capital allocators. Okay, so there's this gentleman in UK who actually gave, I think, 10 million pounds to some 50 money managers. Okay, from 2001 to 2018 or whatever. Okay, and over this cycle, he's basically documented four groups of money managers. Okay, but the biggest insight that came through is the same thing that we spoke, which is that every investment thesis will face some kind of a headwind, some kind of a curveball that you never anticipate. What you do at that point of time determines how successful you are. Okay, and therefore how you are going to respond to underperformance, how you're going to respond to some new change in development. Are you going to buckle down? It's not a bad thing,
Yeah.
but as long as you're consistent with the four approaches that he lays out. Okay, yeah. So that, I think, it's a small book, but it brought in that importance of selling as a discipline. Okay, because that really is the key differentiator, between one money manager and another. It's my firm belief, and it's a small book. I think you of all people will definitely love it.
I'm sure I will. Widely available. It's not like an industry book, right?
No, it's a
Ah.
small book. It's available on Amazon Kindle.
Fantastic. The art of execution, folks. And that is it. That's a wrap on this episode of Paisa Vaisa. I think, you really want to go back and listen to this at a slightly more easier pace once more. There are lots of things here that really stood out to me, especially the stuff on equity, returns, expectations, dynamic asset allocation stuff, how that should be your core, how the mutual fund industry should, will shape out from here. And of course, the quant versus fundamental approach. My guest, Harish Krishnan, Co-CIO and Head Equity at Aditya Birla Sunlight Mutual Fund. Harish, as always, a pleasure having you here. Come back again. Thank you so much for doing this for our listeners.
Likewise.